Okay, we are recording. Hi there, everybody. So I am doing this recorded lecture to cover the PowerPoints for Chapter 4. And so as we have talked about before, in Chapter 2, we went over like more in depth into direct materials. Chapter 3, we went more in depth into the labor calculations and the direct labor function. And now in Chapter 4, we're going more into the factory overhead and kind of how we calculate that and apply that to jobs and all that good stuff. So I am going to share my PowerPoint with you and we'll go through it together and of course get practice in class like we usually do. So Chapter 4, again, accounting for factory overhead. So we've already learned about some of the different factory overhead costs, like for example, maintenance expense for the factory, maybe cleaning service for the factory, factory supervisor salaries, utilities for the factory, depreciation on the factory equipment, factory supplies used. So, factory repairs or machine repair expense, right? So we've already talked about some of these different factory overhead costs. And now we just go into, in Chapter 4, a little bit more in depth about how we apply these costs to jobs, right? All right, so, overhead can oftentimes be a significant percent of a company's cost or the production cost of a company. So, it has to be allocated or divided up between jobs or processes some way, right? Or units, whatever the case may be. So just like we've talked about before with factory overhead and stuff that falls under factory overhead, it's sometimes very difficult to calculate what the cost would be per unit or per job. And so for that reason, what we end up doing, and I've mentioned this in class before, what we end up doing is we end up allocating the factory overhead costs and we calculate this predetermined overhead rate so that we know how much to allocate, to each job, for example. So that's kind of what we're looking at in Chapter 4. All right, so as we have learned before, again, factory overhead can include indirect material, indirect labor, and it gives us some examples. Again, we've talked about these before: indirect materials, glue, and nails in the production of wooden furniture, for example, oil used for maintaining factory equipment, again, those types of materials that are not easily associated with a finished good, right? Indirect factory labor, such as wages of janitors, forklift operators, supervisors, excuse me. Again, direct laborers are the individuals actually on the assembly line or actually within the production process, turning raw materials into a finished good. These other examples, supervisors, janitors, maintenance workers, things like that, are examples of indirect labor, right? And then some of these other indirect expenses, manufacturing expenses such as insurance on the factory, property taxes on the factory, depreciation on the factory or equipment. So again, we have to allocate these and then we have to apply these to different units or different jobs or different processes, right? Depending on the way we're allocating it. All right, so variable costs, fixed costs, semi-variable costs. I think that we have touched on each of these a little bit before, with the exception of semi-variable. So basically, variable costs remain the same per unit, but go up or down overall depending on the level of activity. So, if we say, and I usually write this on the board, and I probably will when we talk about this next week, but if we say that we have a variable cost of $10 per unit, well, if we produce 100 units, $10 per unit times 100 units, that would be a total variable cost of $1,000, right? But if we produce 200 units, again, $10 per unit variable cost times 200 units, then our total variable cost would be 2,000. So variable cost remains the same per unit, but goes up or down overall depending on the level of activity. And so we see that down here with this first graph that they're showing us at the bottom. So variable cost change in proportion to the level of activity. So if activity increases 25%, we would expect variable cost to increase 25%. If activity level decreases 50%, we would expect variable cost to decrease 50%. So that direct relationship is shown down here on the graph. Fixed costs, conversely, are costs that remain the same no matter the level of activity. So, you know, rent on the factory is an example of a fixed cost. The factory supervisor salary, advertising is a good example of a fixed cost. Usually insurance on the factory is an example of a fixed cost. So fixed costs remain the same no matter how many units we produce, no matter how production levels increase or decrease, right? And then semi-variable, or what are also known as mixed costs. Mixed costs have both a variable and a fixed element. So a good example, and they're showing you kind of, you know, the mixed cost here with the stepwise, and then here where it shows us kind of starting from a fixed point and then varying from there. Again, we would have with a semi-variable or a mixed cost, we would have one, you know, an element that's fixed and then an element that's variable. So a good example of a mixed cost is like our electric bill, right? So all of our, like, you know, even in our personal lives, we get our electric bill. Even if we had the lights off and we had everything unplugged all month long, we would still pay like a base amount. And then our bill goes up or down depending on kilowatt hours used. So that's a good example of a mixed cost. Another example that your book gives us is like the maintenance cost on a building, because, you know, we might have a standard maintenance contract, you know, just to throw a number out there arbitrarily. Let's say we have a maintenance contract, you know, $1,000 per month, and they come in and just, you know, check all the maintenance or all the machinery over, and they make sure that screws and bolts are tightened and that everything's oiled up or greased up or whatever that needs to be, right? So we've got the standard contract. That would be the fixed portion. But then if we have something break or something, then we might have to pay additional, right? So then it could vary depending on additional services needed type thing, right? So that's another example of a mixed cost. And so what we can do is we can divide up our mixed cost into their fixed and variable elements, right? And so that's kind of the purpose of some of these methods that you see here. So observation method, high-low method, scatter graph method, least squares regression method. So, you know, observation method, just like it sounds, is simply observing a process and determining, again, which costs are fixed costs, which costs are variable cost. High-low method, we use mathematical equation. I should have typed it in here now that I'm looking at it, but I will write it on the board for us. But basically, we look at high cost minus low cost divided by high activity minus low activity. And that allows us to calculate variable cost per unit. And then from there, we can determine, okay, what portion is variable, what portion is fixed. The scatter graph method, which I'm hoping that we'll get practice with in class. I have a notebook of graph paper, so I'm thinking about doing an exercise where I bring in some of the graph paper and we all get to practice. It might have been a while since you guys have practiced graphing, but anyway, I thought that might be fun to do together. But basically, we're just graphing the points and looking at the trend of the line over the points, right? And then least squares regression method. We're using this formula, basically the formula for a slope where we look at X as the activity level, Y the total semi-variable cost, A the fixed portion, B the variable cost per unit. So we'll see how far we get in this chapter. This is something more that you deal with in stats class, this formula, but it can be applied to separating out these costs as well. All right, so once we have the fixed and variable portions isolated or divided up, then we can prepare a budget, right? So once we have, what our fixed costs are, what our variable costs are, we can prepare a budget. And not only could we prepare a budget at one level of activity, which is referred to as a static budget or a fixed budget, but we could prepare a flexible budget as well. Flexible budgets are prepared for different levels of activity where, again, a static budget or a fixed budget is prepared for one level of activity. Flexible budget is prepared for various levels or different levels of activity. We go more into budgeting in chapter 7 of our textbook. So we will get to budgeting and we'll get a lot of practice with the budgets, but we get into that more in chapter 7. All right, so then accounting for actual overhead. So we have done some journal entries together where we get practice recording overhead cost. And so when we've done this together, we have debited factory overhead and then credited some other account. So if we were recording indirect materials, for example, we debited factory overhead, we credited indirect materials. Or if we were recording, utility cost, for example, we debited factory overhead, we credited utilities payable, right? So factory overhead, we debit factory overhead for actual factory overhead costs. And then we credit factory overhead as we apply that overhead to jobs, to work in process. And so we have seen that journal entry before. Again, when we're applying overhead to work in process, we debit work in process, we credit factory overhead, right? We've done that entry together before. And so here's an example of factory overhead that could be classified this way into different departments or allocated this way into different departments. There's a few allocation methods that we discuss and that we'll get practice with on when we don't have this type of classification in front of us, how we can allocate those factory overhead costs to different departments, for example. All right, so this book or this chapter divides it into two different departments. And again, this is how we allocate or distribute some of those expenses. So a service department is an essential part of the organization, but that does not work directly on the product. So we could think of several different service departments, right? Human resources is a service department. If we have an IT department that services the entire organization, that's a service department. Accounting is a service department, right? So these are departments that don't necessarily produce anything or generate revenue even necessarily, but they're an essential part of the organization, right? Those service department expenses, again, like I mentioned, the IT department, the accounting department, the human resource department, the purchasing department, those service department expenses have to be allocated, right? So depending on, for example, the number of employees per department could be a way that we allocate it, right? We'll look at some examples of those. And then the production department, hopefully we know at this point, they perform the actual manufacturing operations and take, you know, raw materials and turn them into a finished good, right? So some of these example allocation bases, and I'm trying to find, tell you what page I found this on in your book. But for example, like, and this is on page 199 of your textbook, but for example, building maintenance costs or maintenance expenses, we would probably allocate those per department based on floor space occupied. So, you know, if we had a department that was, for example, 1,000 square feet, and then we had another department that was, you know, 300 square feet. Obviously, the department that's, you know, 300 square feet is going to be allocated less of the maintenance cost than the department that's 1,000 square feet, right? So rent is another, you know, common cost or expense that is allocated based on floor space occupied as well. Inspection and packaging would probably be divided up by production volume per department or per process. Purchasing, the number of purchase orders submitted or completed per department. So those are just some examples of allocation bases. Like advertising expense, we might divide up per product sales per department. So it's several different ways that we can do it. This shows you an example, and I'm going to try to blow this up a little bit. It makes it a little bit easier to see. But this shows us an example of how we might allocate some of these different costs. So you see here, these are electrical costs, power, distribution, kilowatt hours. So if we look at the departments A, B, and C and what each department used, then we can determine, okay, if department A used 12% of our power cost, then they're going to be allocated, you know, here's our total power cost, 30,000. So 30,000 times 12%, they're going to be allocated 3,600. If department B used 18,000 kilowatt hours, again, we're going to take 18% times 30,000. They're going to be allocated 5,400. If department C used 20,000 of our kilowatt hours, 20% of our kilowatt hours, if we take that 20% times 30,000, we're going to allocate them 6,000. And then finally, the biggest one, department D used 50,000 of our 100,000 kilowatt hours. So 50% of the cost is going to be allocated then to department D, 15,000. So you see here maintenance cost distribution, that's being distributed based on square feet. So we look at what's the square feet of each department, and we add up the total square feet. So then we know what each department makes up. So if we take, for example, department A is 5,000 square feet. If we take 5,000 square feet divided by 20,000 square feet, then that tells us that department A takes up 25% of our square feet. So they're going to be allocated 25% of the maintenance cost. And then we see the same type of allocation down here for human resources, although this is based on then the number of employees. So, you know, if a company has a total of 100 employees, well, we're going to find out how many employees are in all four of these, you know, in each of these four departments. And then we're going to allocate the human resource cost or human resource department expenses, you know, based on these other departments they serve, right? Okay. All right, so applying factory overhead to production, you know, again, we have already done the journal entry for this, although we didn't have too much in the way of calculation behind it when we looked at it before. Now we're really getting into how we calculate what we're applying to factory overhead. So what we do is we set this predetermined factory overhead rate, and basically the predetermined overhead rate is calculated by taking the budgeted factory overhead divided by some activity base, right? And so that activity base might be, just like it shows here, it might be machine hours as the denominator or the activity base. It might be direct labor hours as the denominator here, the activity base. It might be direct labor cost as the denominator or the activity base. It might be units produced as the denominator or the activity base. But generally speaking, this predetermined factory overhead rate is usually based on historical data. So what were our, factory overhead costs in relation to whatever activity base we used previously? So, just for example, if we chose direct labor cost. So if we looked at the past 3 years and we looked at, okay, what was our total overhead the past 3 years, right? So let's just grab one of them, say 2019. So what was our total factory overhead for 2019 divided by our total direct labor cost? And then that would tell us, how much overhead we need to apply per direct labor dollar. So let's just say that, to make the math easy on us, let's just say that factory overhead was 130,000 and direct labor cost was 100,000. Well, that would mean then that factory overhead is 130% of direct labor, or 1.3 times direct labor cost. So for every $1 of labor costs we incurred, we would also charge $1.30 of overhead costs to that as well. If that makes sense. Anyway, we're going to get more. I know we're just talking about it on this recorded lecture, but we're going to get more practice with it in class, of course. So, all right. So, again, each of these activity bases, whether we're using the direct labor cost, direct labor hour, machine hour, or activity-based costing method. These are all methods that we use for applying factory overhead to production, right? So, again, we mentioned the direct labor cost method. If we use the direct labor cost method, we'd be taking factory overhead divided by direct labor cost to determine our predetermined overhead rate per direct labor dollar, right? If we use direct labor hour method, then we'd be taking factory overhead cost divided by direct labor hours. So then we would determine how much factory overhead we want to charge per direct labor hour. If we were using the machine hour method, then we would take factory overhead cost divided by machine hours. And so we would determine how much factory overhead we want to apply per machine hour. The activity-based costing method, and it talks about this more on page 210 of your textbook, but the activity-based costing method also allows us to allocate overhead costs, but it divides it up into different activities. So it divides it into basically 4 levels. So unit level cost, batch level cost, product level costs, and facility level costs. So a little bit more complicated, but unit level cost are costs that are incurred each time a unit's produced. Batch level cost are costs that are incurred as like a group or a batch of products is processed. Product level cost are costs like engineering and design cost, and they support a particular product or type of product. And then facility level cost, rent, insurance, property taxes, things like that. So activity-based costing gets a little bit more complicated that way. But nonetheless, again, like I said, we'll get practice with some of this in class together. All right. So after we've gone through the accounting period and, whether we do this adjusting entry, on a quarterly basis or on an annual basis, I think more often than not, it's probably done on an annual basis. But remember that as we're incurring actual overhead, we are debiting factory overhead, crediting something else, right? So whether it's crediting accumulated depreciation or crediting prepaid insurance or crediting utilities payable, or, you know, whatever the case may be, as we are incurring actual overhead costs, we're debiting factory overhead, right? We're debiting factory overhead. Those are actual overhead costs. And then once we are applying this overhead cost to work in process, that's when we see this entry. Entry to apply estimated factory overhead to production. So again, debit work in process, credit applied factory overhead. Again, when we apply overhead. So as we're incurring overhead and we're accumulating actual cost, whether it's, you know, utilities expenses, depreciation expense, rent or mortgage payable on the factory supplies, you know, whatever the case may be, as we're accumulating actual overhead costs, we're debiting overhead. And then once we apply this to work in process, that's when we're crediting factory overhead. So at the end of the period, again, whether a company chooses to do this at the end of the quarter, for example, or more likely at the end of the year, we have to determine if actual equals applied, right? And a lot of times it does not. We have to shore up or adjust that account. So just like it shows here, if we end up with a debit balance in factory overhead, that means we didn't apply enough. So if we end up with a debit balance over here, that means our actual overhead was more than what we applied to jobs. We under applied. We should have charged jobs or the production more overhead, right? So if we have a debit balance, that means we were under applied or under absorbed. We had more actual than what we applied, right? And then if we have a credit balance, that means that factory overhead was over applied. So that means our actuals were less than what we charged. So, you know, maybe our actuals were 90,000, but we applied 100,000 to jobs. Then we over applied, if that makes sense. And either way, whether we're under applied or over applied, this is an adjusting entry to cost of goods sold. So if actuals are greater than what we applied, that's going to increase cost of goods sold in the adjusting entry. So we're going to, you know, debit cost of goods sold, credit factory overhead. If we were over applied, that's going to decrease cost of goods sold. So then we would debit overhead, credit cost of goods sold. And so it kind of just explains that here. You know, I think it's easier to look at it and interpret it using the T account like on the previous slide. But again, whether we are over applied or under applied, it is an adjustment to cost of goods sold at the end of the accounting period. All right, so that is the PowerPoint slides for chapter 4. And again, we'll get practice with this. We'll get practice with these calculations and doing this in class together. So I look forward to that. Bye guys, have a good rest of your day.